presentation, and then we'll begin. I'm going to assume everyone can see that. Roger, you can see that okay?
Absolutely.
Great. Well, thank you again, Roger, for that very kind introduction, and thank you everyone for joining the webinar today, Investing in Success. And in particular, because we have, as I understand it, such a global audience. The areas that I'm going to cover today, I'm going to spend a little bit of time about me and my company that I founded 10 years ago called Prime Advantage Capital Partners. Then we're going to look at the landscape that we are trying to navigate along with our founders and our investor community in the overall investment world. I'm going to spend some time in particular how we help clients, founders and strategic partners such as AIMS do that navigation exercise. And then I'm going to try and weave in for you today the implications that that has on talent, and hopefully cover that throughout the presentation. So a little bit about me and my career, my journey that falls into two sections really. First of all, I'm an international omni-channel retailer, and the first phase of my career was in very large public quoted companies such as Next, Arcadia and Mothercare. Over the course of 20 plus years in those sectors and in those companies, I've developed an understanding of global design, product and retail. In particular, international brand and sourcing expertise, launching several businesses across the globe. And then I pioneered Mothercare's first website back in 1998 and the onset of broadband. So I've been in digital commerce for well over 20 years. The second half of my career has been in the strategic recovery and investment space, building a wide range of collaborative partnerships with founders of businesses and their senior teams, and strong alignment with investors and banks. And I offer both parties expertise in strategic, commercial, and operational advice, winning a wide range of successful investments that have allowed businesses to survive and grow. And picking up on the theme that Roger mentioned in his introduction, my goal with whoever we work with is to inspire growth, create value, and generate wealth. So let's spend a moment understanding the market context of investment. It's estimated that there are around $15 trillion of private capital investments and assets under management at any one time. Interestingly, from 2012 to 2022, the annualized growth rate was around 12.8%, and it outpaced the publicly traded stock markets. This sector is anticipated to grow to around $20 trillion by 2028, even more. During COVID, the sector investment generally saw increased volumes and increased values. It was frenzied, as one commentator once put it. But that period has ended, and we've returned to 2019 levels, even those levels of 2018. But there are other factors at play. So looking at 2024 so far, Q1, really the gloomy carryover and caution of 2023 was the predominant feature. Incredibly, 50% of the world's GDP began the year facing an election. Interest rates remained high. And although falling, inflation also remained high. And sadly, as you all know, there is worldwide conflict and political tension. And I'm going to emphasize these two last points later, but these very difficult macro conditions mean that it is very difficult for exits for investors. And that means that there is limited flow of money into new investments. Quarter two, slightly more encouraging, I'm pleased to report. Public stock markets are gaining some momentum. S&P up around 11%, NASDAQ very similar, Nikkei moving ahead to around 16%, their highest growth rates for decades, in fact, and the FTSE 100 around 9% growth year to date. But it's not generally broad growth across many sectors and companies. It is heavily technology led, and that in turn is led by AI, and it is also a factor of a strong energy sector. Interest rates are deemed to be heading down, but slowly. Likewise, inflation is heading in the right direction, and you'll have seen the UK reporting yesterday, inflation dropping to 2%, the lowest for something in the region of 3 years. So let's sort of look a little bit more about the investment overview as a whole. It relies, as I mentioned earlier on, heavily on new money. And that new money primarily comes from exits, from IPOs, from trade sales, and the gains being realized by investors from their investments. And they in turn invest that in new investments. However, these macro exit factors over the course of the last 2 years have been very negative, very poor for investors, and they've either driven low exit volumes or down valuations of businesses, which in turn leads to lower exit volumes. Investors are therefore reluctant to sell, and in particular, they're reluctant to reduce valuations, which will potentially crystallize significant losses or an underperformance in their funds, which in turn leads to their reduced ability to invest. In many respects, founders are the same because they don't want to see their businesses being sold at a lower valuation or seeing down rounds. This leads to a logjam, really, of companies in venture capital and private equity hands. And as a result, venture capital and private equity holdings are now being announced as being much, much longer, even 7 to 10 years. And in turn, this is creating what is called a secondaries market, where investors are just selling to investors rather than, for example, trade sales or IPOs. But with little new money to invest, therefore, 2024 is seeing deal volumes and values running 30 to 40% down versus 2023, and 2023 wasn't a great year. So where is that activity, though? Angels and family offices and crowdfunders play a vital role in driving investment, but the main activity tends to be in private equity investors and venture capital investors. Private equity largely invests bigger amounts and later, and venture capital generally invests earlier and at higher risk, so they need greater returns. If we take a look at the private equity sector first for 2023, the most active investor in each region and the number of the deals they did are identified in the first two columns of the chart on the left. And you can see the US as the most active investor with 27 deals, with the UK at about half of that. If we then look at the sector, columns 3 and 4 of the chart on the left, we can see the top 3 investors and the deals that they did by sector. And the biggest sector, perhaps a little surprisingly, was the B2C sector with 47 deals. But business to consumer covers a wide range of sectors within it. The B2B sector at 46 deals, and technology, which probably dominated the B2B area as well, are the second and third most active. If we look at venture capital in comparison, you can see that the single most active investor in venture capital in the US did 56 deals alone, over twice as many as the top 3 private equity investors in the US. And again, the UK in second place, but you can see China emerging for perhaps the first time in some of the reports that we monitor. The last point I'd make in venture capital is that the top 5 venture capital investors made 195 investments in total in software. So that's actually 4 more than the total number of deals done in the private equity sector by the top 3 investors. So that gives you an idea of where venture capital in particular are looking. Some further trends behind that: AI, climate tech, and health tech have become the key sectors, which may be very important and interesting for you and for AIMS. And these have become the key sectors primarily at the expense of fintech. In comparison to last year and the year before, AI is no longer really deemed as a sector because it is essentially in everything and is becoming a software upgrade coming through on our phones or on our Shopify systems or whatever it is that we're using in our businesses. It is, though, leading to the terminology around Industry 4.0, or the fourth industrial revolution, as it's become called. And the key winners here are expected to be in agriculture, biotech, energy. Sorry, I've just had that screen change slightly. The key areas expected to win are agriculture, biotech, energy, manufacturing, and data services. It's really important for founders and their teams, as well as investors, to be up to date on the whole range of ESG regulations and trends. And what we're finding is that the investment process is taking much longer generally to just analyze new opportunities, to carry out due diligence, and secure credit committee approval. All in all, it's becoming much less of a gamble. So I thought we'd look next at what the talent implications are for 2 very common investment scenarios in light of these macro conditions. And the first one we'll look at is what those talent implications are for those companies, founders, and investors with existing investment. First of all, if exits are taking longer, there's going to be a greater emphasis on resilience and being patient, and making sure that the available capital that is being deployed by the founding team is sustaining strong results, building momentum, and securing growth to keep the investors interested and happy. Teams are going to be focusing a lot on building stronger and stronger relationships with those investors over a longer period, and making sure that their businesses are ready to secure whatever investor funds are made available. Internally, teams and founders are going to be needing to look at effective retention strategies because, again, key members of staff may well have been committed to a business and an exit horizon that has quite dramatically changed. And there might have to be a series of more innovative incentive strategies as well to maintain that momentum and growth that I mentioned a moment ago. And then it's highly likely that founders, teams, and investors are looking at recruitment in key sectors that are emerging around data strategies and certainly AI. If we then look at a second very common scenario, obviously at the moment, is all of these businesses that are looking for new investment, despite the fact that the conditions are difficult. They've got to be able to stand out and differentiate if they are to succeed. They're going to have to be highly specialized and expert in the targeted sectors that they're working in and trying to secure investment in, with specific skills and proven experience. And we're seeing an increasing emphasis on track record. Essentially, have they done it before, Greg, is what I'm being asked a lot. They've got to be excellent presenters, focused on providing high quality information to investors. And they have to have a really serious approach to fundraising. I'm going to show you some data later on that just show how little success, unfortunately, and how small the numbers are in terms of realizing investment. So fundraising is a very serious day job, not something that we do in our spare time. And they've got to have a realistic attitude towards valuations. So it's a demanding market, and we believe, therefore, it's a very, very good time to take on an advisor. And we think advisors make a difference. I'm just going to give you an example in the UK here for a moment. We estimate that there are around 65,000 businesses seeking funding in the UK at any one time, with less than 10% securing investment. Of those, only 1% of startups receive funding. And sadly, 80% of those startups fail in year one and 96% fail in year two. And that is why investors make their money in return from around 4 to 5% of their investments. So there are some really significant implications for founders and for senior teams here. They've got to defy the odds. And whilst they are passionate and expert in their chosen categories, that might not be enough. They have to ask themselves, do they have the strategic, commercial, and operational qualifications needed to secure investment and succeed? And this is where we'd like to think that Prime Advantage Capital Partners gives them an advantage. We've been established now over 10 years in the advisory and corporate finance sector. We have 15 partners with extensive sector expertise and deep experience in the consumer sector, which I lead, the mobility, energy, health, and data services sector. We've got a proven track record from large corporates to successful business startups and exits of our own. And we offer hands-on, peer-to-peer strategic, commercial, and operational advice that is tailored support for founders and senior teams. It is not cut and paste consultancy, and it is not a traditional non-executive director role. In addition, we provide a wide range of real-time insights and connections from our own portfolios and networks of investments that we make and our clients that we work with. This works alongside a close collaboration with a select an expanding group of global investors. And we look to add as much value to our investor network and our investors as we do to the clients that we are helping raising money for. Those investors are drawn from the ultra high net worth and high net worth communities, family offices, which often sit adjacent to those individuals, and then early stage venture capital and private equity investors. And the investment focus that we have is on pre-seed, seed, growth stage to Series A. All of our businesses that we work with go through our Investor Ready program. This is not a 6-month accelerator or something like that. It's far more boot camp orientated than it is, as I say, a sort of a program over a long period of time. But we do find that so many founders that we meet are simply not prepared to raise money. And ironically, they are not invested in the process of securing investment. We start a 10-point assessment and review with our Know Your Customer and Anti-Money Laundering checklists. There is then a full review and preparation of the key investor materials, such as the investor deck, pitch deck, and financial model. We then begin the fundraising strategy and development program, in particular focusing on sector and stage alignment, which is crucial for success. And we build our long list and short list investor targets. We then commence our campaign of introducing the client to our investor network, alongside any key messaging, any key marketing. And these are all very warm introductions in comparison to just a mass send out of an investor deck on a MailChimp system, for example. All of the clients are rehearsed in terms of presentation and pitching, and they're involved in a range of pitch events and our own monthly pitch event, which actually is one of them is going on as I'm speaking at this very moment. And then what is very, very crucial is we feed back constantly to the client and to the founding team, and we maintain the campaign for them, either until we succeed or they ask us to stop. I'm going to spend a few moments now on some of the detailed criteria behind that investment process and our thoughts around winning investment. Again, I'm going to try and demonstrate how important it is for the talent, possibly that you represent or you're working with, and the role that they're going to have to play in winning this investment. In very general terms, for investors, the proposition has to be simpler to understand, and in sort of everyday language, investors simply have to get it. They're probably looking at this investor deck and these Excel spreadsheets that we spent hours putting together on a mobile phone, on a train, on the way home. And if you've not grabbed their attention in 40 seconds, we may have missed the chance. So the initial objective is to spark interest, engagement, and crucially secure a meeting. The actual investment will come much later, and it will be a result of many, many other factors, ranging from valuation to the chemistry between the teams, to the way the questions are answered and the due diligence. But the key, first of all, is to get that meeting. So what does that mean for talent? Well, it means they've got to demonstrate clarity and strategic thinking for investors, and they're going to have to excel in both their written and verbal presentations. They've got to effectively communicate their business to these investors that we present them to. Of course, they've got to be passionate and focused, but they've got to be attentive to the feedback. They're going to have to work with these investors, so they're going to have to listen to them from the outset as well. Crucially, it's the founder and team's responsibility to realize that it's up to them to win the investment and not the other way round. And they've got to work on the basis that they can't expect the investor to figure it out on their own. They're going to have to stay positive and resilient because they're going to be doing these meetings many, many times. And they should be going into all of them with a learning mentality so that they get better and better. I'm going to take you now through 5 key criteria that our investors look for and we look for in the proposition that we're preparing. The first one is the big idea. And for investors, it is simply one sentence, whether it's product, the service, or the technology. It's what it is and what it does. The founders have to make it clear that the problem exists and then illustrate that to the investor along with who has the problem. That needs to be followed up by the solution, which is easy to understand, and the founder explaining how it solves the problem with its big idea. And if there is intellectual property in place, that's great, and this is a good time to make sure the investor knows that. For talent, they really do have to understand the problem. It has to be deeper than just a surface idea. Likewise, they really have to understand the solution. And when we're going through our Investor Ready program, we kick the tires pretty hard here to make sure that our founders really do understand their problem and solution. And in that context, we really encourage the founders to be honest and transparent with themselves and the team as they strive for true differentiation in the market. We like to see them avoiding jargon and again, avoiding too much complexity. The second key element is proof of demand. For investors, that means, and in particular at the moment, traction, traction, traction. So we get across very early what the business achievements to date have been and the progress that it's making. It's important to present the current status of the business very clearly and provide clear proof of demand through sales, orders, distribution, number of users, number of customers. And even better, if we can create the feeling that there is even greater demand and future pipeline. And we get all of this across through the use of both quantitative and qualitative metrics and KPIs. So what must our talent focus on? Well, they've got to first and foremost show how they have used early funds that they've received, maybe friends and family or an early angel investment, and how well they've used that and how exciting the returns are on the deployment of that existing initial capital. We encourage them to think beyond just developing the product or service. They've got to focus on getting sales and customers, that traction that I've mentioned. We make sure they're recording and analyzing all of their information diligently so that we have the best range of metrics and KPIs to put forward to the investor. And we're constantly encouraging them to continuously improve their metrics so that we can keep investors up to date with exciting new news as the fundraise develops. And then as they're building the case for how they're going to use the money, that must be focused very much on how they're going to use the money to encourage investment in the next round, rather than just deploy the money trying to build a business dream for the next 5 years. The third key element to our approach is how the business will scale. And that is very simply because we find very, very few investors that want to invest in a business that is not going to grow. The emphasis is on how the big idea and the business model is going to work and make money, how the business scales and through what strategies, how the business will differentiate itself in the market and defend against the competition. And then we define what the key milestones, drivers, KPIs, and assumptions are. For talent, they've got to show the investor very, very clearly how they're focusing on making money from the business model and gaining a deep understanding of their routes to market and what are the most effective. And we use this very, very simple model to help them define the best returns on that investment. Everything needs to be concentrated as much as possible in this upper quadrant on the top left-hand side, where there is the highest impact for the lowest effort. And by effort, I mean resource, capital, time. We realize that there will be bigger, longer term goals which have high impact and might need higher effort. And of course, that's an important part of the future, but it's that top left-hand side that gets the business momentum and investment momentum going. And we're trying to eliminate anything in those bottom two quadrants. For the founders, their team, and their talent, the investors are arguably investing in the founder and his or her team as much as they are the business, particularly at an early stage. They're looking for teams, founders that have started, grown, and scaled a business before, and that arguably can outscore a very, very big CV in terms of perhaps companies once worked for. They'll be looking at what the founder has achieved so far and how much they have on the line. And they'll also be looking to who else is business critical in the senior team. Where are the skills and where are the experience gaps, for example, against the plan that's been presented? They'll also be looking very closely at salary levels and the demands of founders and their teams versus the long-term success and rewards and incentives that really the investor is looking at. We see too many founders coming from significant salaried roles and arguing that they need a salary, and this can be a significant deterrent for investors. For talent, it's about their experience and expertise to execute the plan that they are proposing with the money that they are asking for from the investor. They've got to demonstrate their deep knowledge of their business, its customer, and its market, and do that with a rigor and depth that impresses the investor. Both parties should be looking for chemistry between the team and the founder, if you're the investor, but also the founder should be looking for whether or not there's chemistry with the investment team. We like to see a positive investor-team relationship right across the portfolio. And then finally, the founder and their team have got to make sure their goals are aligned, the business vision is common throughout them, and that there is a clear understanding of what the exit strategy might look like. And then last of all, we do quite an extensive piece of work around the financials. There will be a 5-year integrated P&L, cash flow, and balance sheet model prepared. And we like to encourage the use of bottom-up assumptions that clearly link to the proof of demand metrics and KPIs that I mentioned a moment ago. We'll need to specify the right amount of investment and detail how that investment will be spent. But in particular, explain what the investment that the investor is making will achieve for the business that they have invested in. When needed, there will be a clear valuation required and then an outline of the exit strategy. The talent will have to prepare that model, and it will need to seamlessly reflect the business plan. They must make sure that it is up to date with the latest financial performance and assumptions. And again, we work hard with founders to make sure that that's the case, and we're not sending information that is 2, 3, 4 months out of date. We encourage that there is internal financial expertise in the senior team, and we encourage them all to understand what the value expectations are and what type of investor is needed. And then they must make sure that they have a common set of goals, timings, vision, and exit strategies. And then again, we encourage the appointment of key advisors throughout the process. So what I've taken you through in this presentation is just the investor ready part, not the process that follows in securing the investment. And I've done that for the very important emphasis, really, that you have to get this stage right so that you give yourself a chance. If you don't get this stage right as a founder and as a team, you simply don't get the chance, because you will not get an investor to meet with you. There are many factors that determine the success in the investment and fundraising journey, and I've touched on just one or two. And I'm pleased that our approach is succeeding, and we significantly overachieve against the market averages. However, particularly with this AIMS audience in mind, the quality and strength of the talent, we believe, and we continue to find, has the highest and clearest correlation to success. That's my presentation. I hope that's been informative, interesting. I think I'm roughly on time, Roger, as you've come back on, and very happy to take any other questions.
Thanks very much, Greg. That was really, really interesting and very appropriate for this group that you're addressing, particularly the overview in terms of the importance of the talent that's coming into the business. And on that point, just a question, if I may, to start off, a number of questions I think people may have. What influence do you have with your portfolio businesses in respect of the talent that's within them?
We're retained in both an advisory capacity, where we might not be raising money, but we might be working, as I've said, peer-to-peer with the founders and their senior team. We're involved with the investment raise, and in some instances we will be advising and helping them with the raise. So throughout, our influence will be quite high. We'll be getting a very clear and first-hand understanding of the quality of the team. If it's in a particular area, we'll be discussing with the founder whether that team is performing, or whether or not it's going to operate at a high enough and sufficiently high enough level in front of investors. And we'll be feeding back only primarily to the founder, obviously, but we'll be feeding back that I think this part of the team is working well. I think the gaps are too great here. We may well find that, for example, if I go back to that financial model, if that is not getting through the scrutiny of an investor, we'll be feeding that back directly and saying that that part of the organization is going to have to improve or be reconsidered. So it's quite a significant influence on the founder and their view of people. What we can't do is operate at an executive level, obviously.
But presumably the investors are cognizant and willing to take the advice and guidance that you may have where you feel somebody within the leadership team is not performing as they should be.
Yes, I mean, one of the big benefits of the way we operate with a close and warm group of investors, as opposed to, as I said, sort of just sending investment decks out over an email system, is the quality of the feedback is direct from the investor, which helps the founder in particular. Now, that might be strategic, that might be operational, it might be something in the finance area, as I said, but inevitably it will always include something about the people. So it is not necessarily our view of the founder and his or her senior team. It's actually directly coming from the investor as well. So it's high quality, it's independent of our view. We may well share that view, we may not, but it will be direct from the investor.
And in terms of those businesses in which your investors have made an investment that are large enough to have an HR function, in your experience, are the HR leaders generally aligned with the intent of the business overall, so that they can do their job and make a contribution to running the business profitably?
I think, if I'm honest, that is going to be a case by case basis. We find that more than we do as a general theme. I think we're at a fairly early stage with a lot of our investors, with our founders in investments. So they are principally in a growth stage, and it's actually the HR element, the recruitment element is about maintaining growth at one end, and then the other issue that often emerges is where an early team isn't able to grow, or an early member of the founding team, for example, isn't able to keep pace with the growth of the team. And that's where founder stroke HR team probably comes into play most of all in this growth stage. It's a real balance as well, between an HR function finding people that understand where the business is. Very often it's a combination of things like salary, exit options, incentive schemes, sweat equity, all sorts of things that are going on at these early stages as well. And not everyone is cut out for that in terms of how they want their sort of career to develop. So it's often very, very key that the HR functions are really clear on where their business is and where they're recruiting from, shall we say, from that point of view.
Yeah. Just changing the tack slightly, another question that's come in, being investments internationally. From the list that you presented, China was down the list, but increasing. You said, I think, that for the first time that it appeared on the list, somewhere on the list at least.
Yes.
Do you see that involvement or activity from UK and European investors increasing in China over the coming years?
I suspect it's going to, yes. I mean, I think I'd answer the question first by saying the international reach is just increasing anyway. So we're seeing a lot of activity and interest from the GCC countries, for example. We ran an event last month with a specialist investor in the African continent, and we're actually doing work there. We see China particularly emerging in a number of areas, technology obviously, but certainly when you look at my area in consumer, the Chinese consumer in particular is probably already evidencing what is predicted to be the sort of the high street of the next 5 to 10 years, in terms of the way automation in shopping, live shopping, artificial intelligence, assisted shopping, all of these sorts of things, they are probably operating in the most advanced way. So we expect it to be led in our categories and at our earliest stage, very much by China from that point of view. So we're gradually reaching out more and more there. And I suspect we're going to see, that number increasingly visible as we move ahead. Yes.
Yeah. And in terms of talent generally, due diligence process and presumably guide the investor in line with that due diligence. Do you actually assess talent in terms of that's within the business already, a pitch for funding? Do you actually get involved in that process, or do you rely on the person who's having the investment having done that already?
Yeah, that question broke up quite a bit there for me, but if you could you just say that again? You broke up a bit for me there, Roger.
The due diligence process, do you
Yes.
rely on the observations of the person who's making the application for investment to guide you accordingly in terms of the potential as within the business, or do you undertake your own assessment of that talent?
We're doing it conscious. We will be doing it consciously and subconsciously because of the depth of our expertise and experience. Particularly if you look at my background, 20 plus years large corporate, and then the 20 plus years in the small, medium-sized sector, I inevitably am critiquing the person, or through our investor ready process, there may be challenges and opportunities to see how that person performs. It's an inevitable consequence of what we're doing. If there is sort of significant concerns, we would pass that back to the founder. Yes, we have to, because a lot of our model works on a success only basis. Although there are investor ready fees, they're not significant. Our sort of main revenue model is on a success only basis. So in the same way as we're trying to eliminate strategic risks or commercial hurdles, or make sure that the investor is well presented to, we're obviously making sure that other barriers around the people and talent area are equally not, putting our success at risk.
So in saying is in your presentation that you're looking for people with a very successful record who've been there and done that, and these are very difficult to find. But there is your gut, because of your own personal background and experience, and that those of your colleagues invariably indicate whether a person is going to succeed or not with their own performance.
Yes.
Does that mean any formal assessment process?
We wouldn't carry out necessarily a formal process, but it's very common that investors do. And that formal process, as I'm sure you know from your expertise in this recruitment world, there are trends in what that should look like. There are sort of certain systems that are in fashion or out of fashion. I can remember in my corporate life it was always very much Myers-Briggs, for example, that I was spending time on, or then there'd be something else to go with that. So it's likely that there's going to be something formal from the investor end, probably more likely as you go up the investor tree towards private equity and larger investments. I suspect there is something in the head of every angel investor that has formed as a pattern of where they've succeeded in the past, where they haven't succeeded, founders that have succeeded, founders that have failed. And they'll have that system sort of in their head, Roger, as they're going along, meeting the investor. It might not be formal in the sense of completing the document and sending back the PDF or whatever it is, sort of thing. But it will be formal in the context of that angel and their experience. And they'll have their criteria. We have an angel investor, for example, in the technology area, and she is adamant that she will not invest in a technology early stage business that outsources its technology development, because she doesn't see a correlation between that, a founder, and a founder abdicating, so to speak, the technology development. She believes it's got to be close, intimate, joined at the hip with the CTO, and they're developing that technology business. Now that might be very different for a energy drinks business, perhaps. I don't know. You know what I mean?
But I know what you mean.
She's got that criteria from 30, 40, 50 investments that she's made. And it's come from the ones that have succeeded, or the mirror image, the ones that haven't succeeded.
Yeah. Another interesting question that's come up is, how do you align your investors with the people who need the funding? So you have people who come in, obviously requiring funding. How do you select the most appropriate investor to match him in with the people requiring the funding?
Broadly speaking, investment is defined, and we work on a matrix of sector and stage. So the sector is fairly straightforward. It's in the consumer sector or the biotech sector, or some of those names that we mentioned earlier on, B2B SaaS sector. So that part's fairly easy, in the sense that you'll have investors that are very specialized in those areas at one extreme. You will find quite agnostic investors as well. At the moment, it's the more specialized investors that are the most active. And if they really know their world and their sector, they are less concerned about some of the turbulence that there is in the world today, because they are sort of operating below that general sort of set of trends. Agnostic investors, in comparison, are more cautious, more nervous of the current situation. So sector is one key aspect of the matrix, if you like. Then the stage is the other critical element. The stage being defined usually by the progress of the business and the amount of money that is being invested. So pre-seed, seed, growth, Series A. Series A probably is revenues, north of 5 million, raising £1 million to £3 million, shall we say. Profitable, on its way to profit as a company. Pre-seed could be £250,000 to stay within the SEIS incentives and tax band advantages. Some traction, a good pilot, first couple of orders, those sorts of things will be pre-seed. So matching those two investors' criteria together is the first main thing we do, because in very simple terms, if an investor only invests in medtech, which is a medium to long-term horizon, and only invests £10 million and more, there is no point, and this is an extreme obvious example to make the point, but there's no point showing them a retail business that's raising £250,000, highly seasonal, and is product or fashion based, shall we say. So it's that alignment that's absolutely crucial. The second thing where I think we really are succeeding at the moment is we spend a lot of time with the investors. We're finding out what they're looking for, what they're working on. what's working well for them, what they don't want to see, because you know, they're receiving hundreds, maybe thousands of decks a year, and just cluttering up inboxes is not a smart move. So we get to know them really well. And what we've started to see increasingly, which I think is a really important signal, is that they are actually asking us what we have in a certain sector. So if you take female founders, for example, a number of people over the last 24 months have really started to address the balance in their portfolio in terms of diversity and inclusivity. And they will be looking to us to sort of, you know, they might come on the phone call, they might, you know, we might meet, talk to us about what you've got with female founders, or talk to us what you've got in health and beauty. That area is doing really well for us. So they're actually asking us, and therefore the alignment is significantly greater than just aiming a investor deck at somebody's email address.
Yeah.
As nice as the email will be that I write, it's not as well targeted as obviously getting to know the investor really well.
Yeah. And a final question, Greg, because we're coming up to 3 o'clock now, and we said 40 minutes and 20 for questions. If we've had 2 or 3, we're in the life sciences sector, as you know. I've had 2 or 3 people approach me to see whether I knew anybody in the marketplace who could help them, A, for seed investment, and B, an additional investment. And I said I could ask around, I could approach people, but moving forward, would you be willing to receive a call from myself and maybe others in the audience who have similar requests, to at least filter those requests to see whether you'd be able to help or not?
Absolutely. We are, you know, instinctive collaborators, Roger, from that point of view. I think probably channel them through me just to keep sort of a process and a level of order, shall we say. But I can then review them. I can perhaps call on appropriate partners out of the 15 that I mentioned earlier on that might have an advantage in a certain category or in a certain geography, perhaps. But as I say, we're instinctive collaborators. We are doing more and more work in a smaller and warmer sort of ecosystem, I guess, from that point of view. So would be delighted to help you or any of your colleagues in that context, of course.
And that means on an international basis, Greg.
Absolutely. I mean, we're pushing hard in an international direction at the moment. One, because as we've touched on earlier on, there are investments and funds and high net worths, you know, beyond these shores in the UK. And secondly, we're actually seeing, you know, businesses having to succeed, having to have an international dynamic.
Yeah.
It is not simply enough to have a domestic strength. And so many investors are interested in businesses that they can invest in that maybe, shall we say, UK based, but then they help achieve success in their local markets. And they see that as part of the sort of quid pro quo, perhaps. And very often they bring a lot of expertise. It could be franchising skills, for example, in GCC. And they may well ask, can I, you know, if I invest, can I have the rights to that territory? So we're very much on an international trajectory at the moment.
Greg, that's absolutely excellent. Just in summary, apologies for disappearing halfway through your presentation. Nothing to do with you, but my internet connection, which apparently was unstable. So I had to go right back out and come back in again. So sorry about that. But what a speech. I mean, your talk was really illuminating, very apposite because of what's going on in the world right now.
Yeah. Really
relevant to our markets and really relevant to our business sector in which we're operating. So thank you so much for that on behalf of both the audience and myself. It's really appreciated, and thanks for giving your time.
It's been an absolute pleasure working with you and Daniela, and thoroughly enjoyed it as well. You know, please get in touch if we can help. Delighted to do so.
Thank you very much, Greg. Look forward to talking to you soon.
Thank you, everyone, as well. Thank you.
Cheers. Bye-bye.
Bye-bye.